Inflation is the continuous increase in the general price level of goods and services in an economy. High inflation causes various costs for both producers and consumers. Let's examine what these costs are and how they can be reduced. The costs of inflation include loss of purchasing power. Inflation means a decrease in the value of money. In other words, less goods and services can be bought for the same money. This negatively affects the living standards of consumers. For example, if a person who can buy a loaf of bread for 10 teraliters has to pay 15 teraliters due to inflation, his purchasing power will decrease by 33%. Depreciation of securities. Inflation reduces the real return of fixed income securities, such as bills, bonds, deposits. In other words, if the interest or rental income from these securities is lower than the inflation rate, investors lose in real terms. For example, a person who deposits $100 at 10% interest will receive $110 a year later. However, if the inflation rate is 15%, the purchasing power of that person drops to 95 teraliters. In this case, investors want to sell securities or look for alternative investment instruments. Increase in production costs. Inflation also increases the prices of factors of production, such as labor, capital, raw materials. This increases the cost of producers. Manufacturers have to reflect this cost increase in their prices or reduce their profit margins. Rising prices can reduce demand and lose competitiveness. Reducing profit margins can reduce investment and employment opportunities. Deterioration of income distribution. Inflation may increase the differences between income groups. Especially those with fixed income, such as pensioners, civil servants, workers, are more affected by inflation. Because their income increases below the inflation rate or stays the same. On the other hand, those with variable incomes, such as employers, self-employed, speculators, can increase their income by adapting to inflation more easily. In this case, inequality in income distribution may occur. Economic instability. Inflation creates uncertainty and insecurity in the economy. Both producers and consumers can delay their decisions about the future or make wrong decisions. For example, producers may avoid investing or engage in speculative activities. Consumers, on the other hand, may give up saving or turn to consumer goods. In this case, economic growth and employment are negatively affected.